Good evening, everyone. Very good evening to everyone sitting across the table, waiting for the initial lecture, for the first lecture of financial management for this live lecture series by the ICAI. I welcome you all to this interactive session. We'll try to make it as interactive as possible through the chats, and I'll try to address whatever queries you have, right? So this is going to be the first session of financial management as far as I understand, correct? And I can already see a lot of students excitedly waiting for it. A lot of good evening messages. Good evening to everyone. I can't call out each one's name, but then definitely, yeah, all your messages are reaching me. Well, we'll be starting this exciting subject of financial management, which you guys will be learning for the first time, correct? This is a subject which you're going to get used to or get to know about this subject for a very first time. So let's just begin with the subject, or as an introduction, let's first get ourselves introduced with the subject as to what is this subject really all about. Okay. Uh, so to understand what this subject is all about, let me first write down the name of the subject. Its name of the subject, as it says, it is financial management. Okay. So that's financial management. Let's try to break this subject title into two parts. The first part is definitely what we say over here as the financial part, and the second is the management. Let's first focus on what is management. Okay, let's first focus on what do you mean by management. So essentially, management means getting some things done from others, or you might have done some sort of definitions in your commercial studies or some subjects of that sort in your 12th standard, right? So management means getting it's the art of getting the things done from others, or it's the task of some directing, controlling, right? All those things are there, but essentially, what do you mean by management? I can clearly say management is nothing but it is the task performed by managers. This is the task which is performed by the managers. Now, essentially, what task is really performed by our managers? What is the task that is performed by managers? If you talk of any manager for that case, the HR manager, the production manager, the sales manager, what is the task? If I talk of HR manager, what is the activity that the HR manager does? So essentially, HR manager is responsible for getting the right people into the organization and placing them in the right place, right, or right profile of the work, right. So that's a task performed by the HR manager. Similarly, what's the task performed by the production manager? Production manager would be a person who would be excited to get the finished product or a fine-tuned product out of the production line. And for that, it needs to get proper raw material, proper spare parts for the machinery, assemble it into one together, and get the best out of it. So when we say the task which is performed by the production manager, task would be to get the raw material, use it in right proportion, and get the finished product, get the best finished product that is possible. Similarly, to say the sales manager, the task of the sales manager would be to strategize the sales operations, or maybe appoint appropriate salespersons at appropriate location, so that the output is best possible sales numbers. So if we talk of the task performed by sales managers or any manager for that task, they are essentially involved in just two activities. Categorize all the manager activities into two categories. One is raising of resources, or you can say getting resources to the organization. That is the first task that a manager does. The raising of resources is the first task. Second is utilizing the resources. So whatever resources you have raised, you need to actually utilize it to the best possible manner. So task performed by the managers is first of all raising of the resources, and second is the utilization of the resources. First is raising, getting the resources into the organization and utilizing the resources in the best possible manner. You talk of HR manager, the HR manager does the same. The HR manager gets the resources for you, I mean, gets the resources for the company in the form of human resource and then placing them at the appropriate job profiles. Similarly, the sales manager is responsible for getting salespersons and placing them into the appropriate business segments. Production manager also does the same thing. So, of course, when we are talking of finance manager, the financial manager, as the name says, the financial means the word, it's obviously indicates, we are related with some sort of money. Correct. So raising of resources and utilizing of resources. So finance manager is supposed to do the two activities. One is he need to get the financial resources. The first is raising of funds. So he is going to be involved in raising of funds. Yeah. So the finance manager is going to be involved in raising of funds or raising of money, and he will be involved in utilization of the funds. Right? So it's the finance manager's duty to get an idea from where the funds are going to be raised for the company and where the money is going to be utilized. So our syllabus of CA Inter Financial Management is all about answering these two questions. We are going to understand the various ways of getting the money for our business and various ways of investing the money for our business. Now, if I ask you, what are the broad ways or what are the broad sources from where you can get the money? Can you tell me what could be the broad ways or sources from where you can get the money? Just want the categorization. Okay, you can say so. These funds can be essentially raised from two sources. Either the funds you're raising will be owned funds, or it can be borrowed funds. The funds that you're raising can be owned funds or borrowed funds. Broad categorization goes into the same. You call it shareholders' money, you call it retained earnings, you call it debentures you're going to issue, getting a bank loan. So all those you can simply categorize into these. Either it will be a owned fund or it will be a borrowed. Nothing can be beyond this. Okay. So how much owned funds to be raised, how much debt funds to be raised, and how much essentially bank loan needs to be taken. So all that call needs to be taken by the finance manager. Similarly, utilization of funds. If you look at utilization of funds, where can the company essentially put the money? Where can the company essentially put the money, or where is it going to invest the money that has been raised? So investment can happen definitely in again multiple areas. So one of the areas could be you putting it into non-current assets or the fixed assets, as we say. So you may purchase a machinery, a factory building, a furniture, and equipment uh, by using the funds that you have raised, right? Secondly, you can utilize that money in the form of keeping raw material in your godown, putting debtors on making goods on make sale of goods to the debtors on credit terms. So you essentially put that money into current assets. So you can invest the money. The finance manager can invest the money into the fixed assets or into the current assets, which are essentially required for operating the business. Now remember, these two assets that we're talking of, these are your operating assets. These are the operating assets of the company, which essentially talks of where the company has put up the money in the form of operations. Okay, so you can invest the money in long-term assets, or you can invest in short-term assets like the stock or debtors, or maybe put some money in bank also for the day-to-day operations. Apart from this, you may also put aside some money into investments. So you can put your money in some bank FDs, keep some reserves aside, keep some investment for future contingencies. So that is where you can invest your money. Now, in what proportion should I need to get these funds? In what proportion should I need to invest these funds? So all these decisions are going to be taken by the finance manager. And that is what the entire financial management subject is all about as far as CA interest. We'll have a closely look at, wherever, what are topics are there. Based on those topics, we are going to decide where that topic actually fits into the objective of our financial management subject. So as we say, raising of money. So where do we get or how do we decide from where to raise the money? For that, we are actually having a set of chapters. Let me just write those set of chapters. Yeah. We have, as far as raising of money is concerned, there is a chapter called as cost of capital, which you'll definitely learn in the due course. This tells us about how much each type of capital is going to cost us. Secondly, if you're raising the money, in what proportion should you raise the money as far as debt and equity is concerned, or as far as debt, equity, or preference share is concerned? So the second chapter, which talks of raising the money question, is capital structure. Third chapter is leverages, right? So all these three chapters are what we call as raising of funds. These three chapters are essentially targeting the part wherein we are talking about raising the funds. So what is the cost of the funds that we are getting? How much proportion should we have? And leverages is all about talking, how risky the proposal or how risky the company is going to be as far as funding and operations are concerned. Similarly, where should we invest our money is covered by these topics. One is the investment decisions. Wherein we are going to decide whether investing in a long-term capital asset, is it going to be profitable for the company or is it not, right? Similarly, as we look for long-term assets, there we have another topic which is called as working capital. This talks of investment that the company makes into short-term assets, maybe in the form of debtors, inventory, creditors, so on and so forth. Another area where the company need to decide where to invest the money or where to use that money is the dividend decisions. Okay. Dividend decisions, whether we should pay the dividend to the shareholders or not, or what should be the rate at which you should be paying the dividend. So that is what is covered by these three topics. So these three topics essentially talk of utilizing of the monetary resources, right? There's another topic which we'll be doing, which is called as ratio analysis. As the name says, it's about analyzing certain ratios, which is also you can say it's a financial ratio analysis or financial analysis of any company based on the financials of the company. And one more thing which we can say about raising of funds. First, we need to know from where to, what are the various sources of raising the monies. So that's actually zeroth topic, which is our today's topic that we are going to deal. That is sources of funds. Sources of funds. This is what we are going to do post the break. Now, of course, these four set of topics, we have it in the raising of funds. Then we have utilization, and then we have another topic called as ratio analysis, which is going to deal with the numerical analysis of the financial statements, wherein we'll be actually undertaking a health analysis of, financial health analysis of a given company. Okay, so that's the broad idea that we have about the financial management as a subject in CA interlevel. Okay, so the first half of our today's session, it will be about discussing what all things are there, that is the scope and objectives of the financial management subject. Then post break, we'll be discussing about the various sources of money. Okay, so let's begin with the first aspect, which is the scope and objectives of the subject of financial management. Okay, so before I go ahead with that, I would like to simply ask you a question. What do you mean by value of a company? How do you determine what is the value of a company? Yeah. How will you determine what is the value of a company? Is it dependent on the shares? Is it dependent on the share price of the company? Is it dependent on the number of shares that the company has got? No, I'm not asking in that sense. I'm talking of tell me value of company will actually depend on which factors. Value of a company is going to depend on which factors. What are the factors which are going to be playing a determinant role in value of the company? Essentially, value of a company is a function of uh, how the company has financed its business. Because if the company has financed its business with such capital which has got very high cost, so high cost capital will definitely not add value to the company. You need to get your business funded with the lowest cost of capital. Similarly, your value of company will be also determined by how you are investing your money. What is the rate at which the company has put up the money? What's the rate of return that the company is expecting from its projects? And thirdly, one more parameter which is going to put a value on the company is dividend. How the company is paying dividend to its shareholders. Now, remember one thing in this subject, we are going to deal with a primary focus on joint stock companies. We are not talking of sole proprietorship. We are talking of joint stock companies in the entire subject. Okay, so we say value of a company is going to be dependent on these three parameters: where the company has got the money, where or how the company has raised the funds, how it has invested, and whether it is going to pay dividend and at what rate it is going to pay dividend. Okay, so value of company is essentially dependent on these three parameters. Does it make sense, everyone? Does it make sense? Yeah. So if the company is funded with low, you can say the value of the company is going to be higher if the funding has been done with the low cost capital. Investing has been done in the highest form of, investing has been done in areas which give you the highest rate of return. And dividends, again, whether you have invested at a higher rate or at a lower rate as compared to financing, that will be a determinant factor. But generally, we can say the company is able to give good rate of return in the form of dividends. That will definitely add value to the company. So value of a company is dependent on what is the cost of financing that the company is incurring, what is the rate of return on its investment that the company is able to generate, and how much dividend is going to pay. Okay, so value of a company will be high if cost of financing is lower, rate of return on investment is higher, and generally if the dividends are higher, investors will put a more value. Okay, so this F was actually indicated of function. Value of a company is a function of these three things, right? Okay, now let's talk about scope of financial management. What all things are really getting covered in this subject of financial management? Scope of financial management. Yeah. Scope of financial management. Uh, so first up, this is going to tell us what all things are going to be covered in this topic or the subject of financial management. Now, uh, first up, when we talk of scope of financial management, what we have is, as a finance manager, what is your rate? What all things you need to perform? First up, you need to determine the size and rate of growth of enterprise. So as a finance manager, you need to have a vision of what sort of company you are looking ahead in future, as to what should be the size of your company in terms of market cap, in terms of sales figures, in terms of profitability, and what growth can you anticipate from that. Okay. Then, of course, the next aspect we can say, uh, as a finance manager, you need to determine composition of the assets. You need to determine what all things are going to be there in the assets, so composition of the assets. What assets are you really going to deal with? How much non-current assets you're going to have, and which non-current assets you're going to deal in, what sort of inventories and for how long you're going to hold the inventory, what should be the credit period you're going to give to your debtors. So that's going to be the composition of assets. Third scope, which you as a finance manager are supposed to be determining, is you need to determine what is the debt equity mix that is best for you. You need to determine debt equity mix, right? And another activity which, as a finance manager, you're supposed to do is you're supposed to analyze, plan, and control financial affairs of the enterprise. Okay? You need to analyze, plan, and control the financial affairs of the company. That's your scope of as a financial manager. As a finance manager, you're supposed to be looking at this. So essentially, uh, what are you really looking at? If we put this entire scope in the nutshell, what is the objective of this entire aspect? So from this, we have the connection with the objective of a finance manager. So before we go to this objective, uh, I would like you to focus on two important terms. One is profit maximization, and other is wealth or value maximization. Okay. So one area is profit maximization, or the other area is wealth or value maximization. Do you see any difference between these two? Do you see any difference between these two? Yeah, guys. Profit maximization and wealth maximization, or both of them are same to you? What is your take on it? Yeah. Are they one and the same thing? Of course not. But let me tell you, as a finance manager, what are you really looking at? Remember, all these activities that you're going to do, all these activities that you're going to do, uh, that is definitely going to be focused on wealth or value maximization. So scope of financial management is going to be these four objectives, four scope, but all of them are going to be focused towards the wealth and value maximization. Now, what is essentially the difference between wealth and value maximization? First of all, profit maximization, when we say, we are talking of the book profits, the profit after tax or the net profit that is reported by the company. But this term, profit maximization, has got some shortcomings. It has got some shortcomings that we need to really look at. So if you compare what is profit maximization and what is wealth maximization, just if we try to put up certain things over here, when you say the term profit, when you say the term profit, profit is simply your income minus expenses. Profit is simply income minus expenses. So generally, if you want to have a higher profit, you need to have a higher income and lower expenses, right? So that's how you can attain the objective of profit maximization. If you want to have a higher profit, income should be higher and expense should be low. Whereas, what do you mean by the term wealth? Well, wealth is all about present value of future benefits. Wealth is all about present value of future benefits minus present value of all your future costs. So if you want a higher wealth, you need to have higher benefits and lower costs. So wealth is basically present value of future benefits minus present value of future costs. That's what we simply mean by the wealth term. Now, how do you get the present value? We know the present value formula that we might have learned in our foundation level, where we have stated that present value is nothing but future value divided by 1 plus rate of return raised to n. So you just try to forecast what is a future profit or future cash inflows that the company is going to have, and you just stick to the present value, that is the wealth that you're talking. Now the problem with profit maximization term is the term profit. The term profit itself is vague, and it is subject to definitely manipulation, because profits are basically estimated, right? Or profits are basically calculated based on certain assumptions, based on certain estimations. Like you estimate the amount of depreciation, you estimate the amount of realization value from the debtors, you estimate the value of the inventory that you have in your stock. So this profit figure is actually dependent on a lot of estimations and judgments, right? Which may be differing from person to person. So this profit as a term is supposed to be a vague thing. Similarly, when you talk of profit maximization, it doesn't take into account the risk involved in a higher profit. Profit maximization, the term profit maximization does not consider risk involved. So a project may seem profitable to you, but you can't just overlook the risk involved in it, right? So profit maximization does not take into account the risk in it. some technical issue, guys. Just give me a moment. Now the screen should be visible. Okay. So profit maximization as a term, it doesn't take into account the risk involved in a very project. And therefore, we say that this profit maximization term is a narrow term. It's a narrow term. Now, uh, all these aspects, all these negatives of profit maximization is actually getting, covered, or they're getting eliminated in wealth maximization concept. Like if you say profit term is vague, because in wealth we actually don't deal with term of profit. What we deal is we'll talk in terms of cash flows and not accounting profits. So when you look at wealth maximization, this is actually a cash flow approach. This is a cash flow approach and not an accounting profit approach. Like accounting profit can be sometimes really funny, whereas the cash flow approach gives you a more realistic picture. Okay, let me just give you an example for that. Suppose you start with a business and you have a balance sheet and a P&L. Now, suppose you start your business wherein you are making a sale of 10 crores. Let's say you sold goods worth 10 crores, but on credit. So where did we get this sales? Let's say you purchased goods worth 8 crores. Again, this is on credit. So what is the profit that you book? So we book a profit of 2 crores. On the balance sheet side, you will find that there is a amount of reserves of 2 crores, creditors of 8 crores, and debtors of 10 crores. Now, if you go to a banker or if you go to any regulator with this sort of balance sheet and P&L, wherein there is nothing happening in cash terms and everything is in terms of credit, everything is working around credit, will the banker or the regulator going to give you permission to raise money from the capital markets? Of course, no, because this is not representing any cash flow happening to the entity. It's just a book profit, which is there's no profit, there's no real cash profit that the company is actually generating over. And therefore, we say cash flow approach is more realistic. It's more, clear as compared to a profitability approach. Okay. Similarly, as you say, profit maximization, it does not consider the risk aspect. Whereas in wealth maximization, we take into account the risk. Because when we are calculating the present value as future value upon 1 plus r raised to n, we are calculating the present value as future value upon 1 plus r raised to n. This r term, which is our required return will be high if the risk is high. So if any project or any investment opportunity where if the risk is high, we actually discount the cash flows at a higher rate of return. And therefore, that risk aspect is actually taken into account when we are calculating the present value. Right? So we can say that fourth point, we can say wealth or value can be simply said to be number of equity shares into market price per share. Or you can say or you can also say that is nothing but value of equity plus value of debt should be the value of the firm or value of the business. So value of the business in essence, it says that it is value of equity plus value of debt. So that's the difference that we're talking of in terms of profit maximization and wealth maximization. Okay, yeah, guys, does it make good sense? Yep. Uh, Perfect. Okay. So now we can discuss more about certain differences between both of them uh, as a way. And page. If you're talking of profit maximization, what is your objective first of all? Your objective would be to attain large amount of profit. Your objective would be to attain maximum amount of profit possible. Uh, this is again we can say it's a short term. Okay. Uh, as I said, risk not considered. Then we can say time value of money is also not considered, right? Because we are not looking at present value or something else. Time value of money is actually not given due consideration over here. And when you want to say profit maximization, it requires immediate resources. It means that you need to put the resources immediately into the action. Then only you can say that next year profit is going to be higher. And this is quite easy to achieve because it's just a short term that you need to do. Whereas in case of value maximization, this is going to be the where an area where it's going to be highest market value of the shares. Then of course this approach is not short term, rather it's a long term approach. Then risk is actually taken into consideration, as we have taken it as we have seen that the rate of discounting is higher for high risk project. So risk is taken into consideration. Then of course time value of money is getting considered because we're taking the present value. Okay. And it doesn't mean that whatever decision you take that the value is going to increase, since it's a long term. So there's no direct immediate relation. There's no direct immediate relation between decision and value. And most importantly, this is going to be a difficult task to achieve because it's a long term process. And that's where that's where the company need to put up efforts to achieve the highest possible value by taking a balanced view of the risk and return. Okay. Now, that's where we come to the next part of our discussion, where we are going to talk of the trade-off between uh, risk and that of return. Now, as the name suggests, risk versus return, what would be your general idea? If you want to get a higher return, what should be the level of risk that you should be that you should be really looking at? Yeah, higher risk. So higher risk, higher return, right? So that's a simple fundamental that we talk of. Uh, you know, risk and return, the trade-off that we are talking. Now, let's simply take an example. Uh, if you talk of SBI, State Bank of India, if you put up a FD in State Bank of India, what would you really be expecting the rate of return? Somewhere around 7% maybe, right? Now, if you are being offered the same rate of return on a company debentures, so let's say a company is issuing debentures and the company is promising you the same 7% rate of return. The company is promising you the same 7% rate of return. Uh, would you really be ready to buy the company debentures? Of course, no, right? Because SBI has got a lower risk, whereas a company debenture has got a higher risk. So company debenture is, or if the company really wants to get its debentures to you, it needs to offer something more than 7%. Now, how much more than 7%? That depends on the risk of the company. That depends on the risk that the company is undertaking. Okay. So obviously, let's say company debentures, let's say it is going to offer you 9%. So obviously, the idea is high risk, high return, low risk, low return. Wherever you go, wherever in this world, this is the rule which is prevalent and which is valid for whatever thing you say. High risk, high return, low risk, low return. So if you are really interested in getting a higher return, you need to be ready to take a higher risk, right? Now, suppose there is a share of a company, or let me just remove the name of the company, and let's say this is the no RIL debentures. Now, Reliance Industries Limited debentures would definitely give you 7%. But if I talk of same Reliance Industries Limited shares, what would be the return that you would be expecting? What would be the return that you would be expecting? Would you be expecting the same 9% return or higher than that? What would be your call? Yeah, what could be the call? Would you be expecting a more than 9%, same or higher? Of course, higher, right? So let's say considering the volatility, considering the changes in the returns that Reliance Industries have actually generated in the past, consider the risk in it, maybe you will require a 13 or a 14%. So this Reliance Industries shares has got a even more higher risk. You take some small cap company or some mid cap company, there you would be expecting definitely a higher risk. Because if the company is not able to generate higher returns for you, it would actually make no sense for you to stay invested in that company, right? So just remember this fundamental: higher risk, higher return, and therefore, since the risk is higher, we expect a higher return. Such high risk project cash flows are going to be discounted at a higher rate. Okay, guys. So that is what we were talking of as risk and return trade-off. I hope this is pretty clear. Yeah. Yes, guys. Higher return expected. Let me just have a look at the query. Higher query. Okay, perfect. No such queries as such. Okay, fine. Perfect. No such queries as such. All are answering. There is no specific query that I can see. Okay, fine. Now, as the subject as a finance manager, it has evolved over time, and I hope you are aware of a position that we see in the current scenario. Have we guys heard of a term called as or a position in the company called as CFO? Sure, you might have heard of it, but still, have you heard the term CFO, Chief Finance Officer? Yeah, have you heard of this term CFO, Chief Finance Officer? Yes, okay. The Chief Finance Officer. This is the highest position that a finance manager can get in any organization. Now, what would be the activity that CFO does? What is the set of activities that a typical CFO does? So, as the subject has evolved, even the activities of CFOs have changed. So, what a CFO used to do and what it does now, what a CFO used to do, and what is it really doing now? Let's have a look at it. First of all, CFO used to do budgeting. Budgeting means where the company needs to go put the money, how much money is to be put based on the resources available. That a CFO used to do. The CFO does the same thing even today. This hasn't left the domain of CFO. Secondly, the CFOs are supposed to be forecasting. Forecasting means trying to forecast what is the likely sales, what are the likely expenses, what are the likely items where the money should be put in, what is the level of debtors that we can expect. Right. Similarly, the same activity is being done even now by the CFOs. Uh, Thirdly, the CFO was essentially involved in day-to-day accounting activities also. Okay. The CFO was also supposed to be looking for or managing, treasury of the company, which is cash management basically. The CFO was also supposed to be doing, preparing and looking at some internal financial reports. Okay. Then he was also looking for filings for investors. Okay. Then tax filings. Okay. Then an investor or the CFO was actually also looking for, managing the debtors, managing the creditors, following up with, their dues or recovering monies from due or taking steps for them. So those were, activities which a CFO was to do. But right now, the activities of CFOs are actually evolved, and right now the accounting aspect has been a bit of done away with, because for that there are subordinates who are ready to do that. So more superior works are being assigned where the CFO is now actually looking for profitability analysis. So maybe segment by segment, maybe product wise profitability, maybe location wise profitability. That aspect is being looked at by CFO. Similarly, CFO is now looking for the pricing part also, whether the pricing is being undertaken in a best possible manner. Uh, Even decision making with regards to outsourcing, whether certain activities can be outsourced to the outside vendors. That is also looking into it. A CFO is also looking into now IT functions. Is also looking into the HR functions. Basically, not getting involved into it, but you need to have a oversight over overseeing the IT functions, the HR functions. He is now also responsible for regulatory compliances. Okay, and obviously he is now obviously more responsible for the risk management aspect also. There's a shift in the way CFOs were to perform their activities. Apart from these traditional activities, accounting, treasury, these are now going to a separate department altogether. Treasury management, financial reporting, there's a separate accounting department altogether. And CFO position has now evolved with more holistic activities that are being taken into it. Okay, so that's the role of CFO, which has evolved over a period of time. Uh, so Priyanka is asking what is the difference between CEO and CFO? Priyanka, it's a chief executive officer and CFO. Chief executive officer is the boss of basically CFO. He's the person who is responsible. He's the chief manager of the entire company. All the decisions with regards to uh, where to which project to launch, how much money to be allocated, what decision needs to be made, what should be the marketing campaign, how the fund should be raised. A holistic activity needs to be done by CEO. Obviously CEO is going to be advised by CFO for the purpose of decision making as far as finance part is concerned. Okay. uh, then we have one more query was there from, yeah, Balaji is asking, can you please elaborate on how debt is going to maximize wealth of an organization? No, debt is not going to maximize wealth of an organization, Balaji. It's about uh, value of the company. It's not maximizing the wealth. When you take debt into account, then only you will get the value of the entire business, right? Because if you look at the balance sheet of an entity on this side, you have the equity and the debt component, right? And on this side, you have the assets. So generally, assets equal to liabilities. So whatever value of the company will be, that is a cumulative value of equity and debt. Like if you want to buy a typical company, you can buy the company by getting all the shares in your own name, but also you need to repay all the debt. So if you want 100% control over the business entity, you need to you need to buy all the equity shares and also pay whatever dues the equity shareholders or whatever dues the debenture holders and bankers. Okay, fine. Okay, fine. Now let's go for another aspect of this financial management where we are going to talk of the agency problem and the agency cost. Remember, we are talking of joint stock company over here. Okay, joint stock company. Now, in case of a joint stock company, what happens is there is a separation of ownership and management. In case of a joint stock company, guys, there's a separation of ownership and management. So the joint stock company is actually funded by the owners who provide funds in the form of equity share capital to the company. They are essentially the risk takers of the entity. Okay. And then you on the other side, you have the manager of the entity, maybe the director, maybe the CEO, the board of directors, the managing director, executive directors. That's a set of management that we have. And these managers are essentially responsible for managing the company. Okay. So joint stock company is actually in between a tug of war, wherein there is a pull from the manager side and there is a pull from the owner side. Managers want something and owners want something. The idea is owners essentially have given money to the joint stock company. Managers have not put anything into the company, right? For example, if we take L&T for that case, Larsen and Toubro as a company. The owners of the company Larsen and Toubro are basically the shareholders of the company. Manager of that Larsen and Toubro company is the board of directors, the managing director, the executive director, the CEO. They are managers. Okay. So, owners of the company have provided money to the company in the form of share capital, and these managers are essentially managing that money. Since the owners are the risk takers because they have put the money, for them risk is very high. So any decision that the manager will take is going to impact heavily the owners because any decision that the manager takes is going to essentially have a huge impact on the wealth of the owners. If the decision is bad, owners are going to lose their wealth, managers are not going to lose any. Am I right, guys? If any wrong decision is taken by the managers, is it going to impact them? No, because they are the persons who are being paid salary. They are earning a fixed income. Their wealth is not dependent on their decisions. But yes, owner's wealth is dependent on what decision the manager wants to take. Now, of course, since they are risk takers, owners will definitely want the company to be investing. Owners will definitely want the company to be investing in such areas, where the risk is minimized because they have put their money. Now, think from your perspective also. If you have put up money somewhere, you will obviously, require that wherever your money is being invested, that should be having the lowest possible risk and highest possible return. So basically, risk-taking capacity of the owners is limited because they have put their money. So risk-taking capacity is something, is lower for the owners because their money is at stake or their value is at stake. For managers, it's a very easy affair because they don't have anything to lose. So that's where there's a tug of war coming in and the objectives are going to different. And that's where we have this agency problem in case of a joint stock company. In case of a joint stock company, there is this agency problem because managers are the agent of the owners in managing the company. The decisions are taken by the managers. Obviously, shareholders do have some powers, but day-to-day operation shareholders cannot intervene. Every small decision that the company wants to take cannot call the general meeting. They cannot call the AGM or EGM and then look at what will be the likely decision. What should be the decision? That's not possible. So day-to-day management, day-to-day decision has to be taken by the managers. Even larger investment decisions are going to be taken by the managers itself. So there is this push and pull that is happening where owners want to take less risk, managers want to take more risk because that will essentially they don't have anything to lose, right? So their set of objectives are different. So that's where this agency problem comes in. Now, to solve this agency problem, we need to incur some agency cost. We need to incur some sort of agency cost to solve this agency problem, right? If managers actually think from the point of view of owners that, okay, we have got the money from the owners, and if we put this money in this project, this risky project, whether this will add value to our investors or whether they will reduce the wealth of our investors, that decision, that sensitivity should be maintained by the managers. If they're not doing that, then there's a problem. Okay, so if manager wants to be aligned, now how do we go about aligning the manager's objectives to that of the owners? Can you tell me any way by which managers and owners thought process should be aligned or their objective should be aligned on the same lines? Only one simple way is, suppose if the company is looking for a project worth 1,000 crores and the managers say that we are likely to get substantial profits, we're likely to get substantial cash flows from this project that will add wealth to our investors. So owners can simply put the managers on hold by really testing whether they are thinking from our point of view, and simply telling them, okay, if you're saying that this project is likely to give you good returns for us, let us do one thing. Let's keep your salary dependent on the project. So if the project performs well, you will be paid for it. If the project doesn't perform well, you won't be paid for it. Now, can I say the managers will start thinking twice whether it is really good to go ahead with the project because my salary depends on the success of the project. So now the manager will be in a position where he will be critically analyzing the project in a more detailed way. He will look into the various risk factors and take into consideration all those risk factors and then take a decision whether it is really going to add value to the investor. So ways to resolve this, disparity in the objective is to have, salary linked to the share price, or salary or a compensation is linked to the profits partially and also to the long term results, because sometimes it may happen that if I link the profits to the if I link the salary to the current profits, maybe they'll take decision only for current profits, not the long term profits. So if I want my manager's objectives to be aligned on the same line as that of me, that is as that of owner, we need to essentially tell them that maybe a part of the salary is tied to current profits, but a major chunk is going to be tied to future prospects of the company. So one way of giving them is, you can just give them ESOPs. Have you heard of ESOPs, guys? Employee stock option plan. Yeah. Have you heard of ESOPs? I think you might have heard of it. ESOPs, employee stock option plans, or something like sweat equity, wherein you pay to your employees or to your top management people in the form of equity shares. Now, of course, if you offer them payment in such terms, equity terms, the managers would be essentially looking for long-term growth of the company. You talk of any successful startup, be it Flipkart, be it Amazon, or be it any startup company which has established its base, or Zomato or Paytm, they have essentially paid their staff. They have paid their staff, in the initial days in form of ESOPs. By that they were actually motivating their staff that you please start, uh, working for the company for a long-term gain, because once the company goes ahead in a long-term basis, then you will be getting the ESOPs in your account. So you can get a higher value of your ESOP if the company is more valuable. So everyone, works in that essence that let's create a value for the company because that will ultimately satisfy my wealth objectives, right? So that's our agency problem and agency cost. Agency problem is basically when managers and owners are not aligned as far as their objectives is concerned. Managers want to undertake risk, but owners are actually not ready to undertake risk because they have actually put up the money. And when that conflict comes in, because there's a difference of objectives, managers would like to just just put up money into the project just because it's likely to give you higher returns without taking into account the risk involved in it. But when we tie their remuneration to the profits of the company, tie their remuneration to the wealth of the company, they will start thinking twice about that, and then take a calculated decision as to whether it is better to put money into it, whether it is better to invest in that project, because my future wealth, my future remuneration is actually dependent on the future prospects of the company. Okay, so that's the part of agency problem and agency cost. I hope this is very clear to everyone. Yeah, let me just look at any queries you have, guys. Any queries? Yes, resource manager. Okay, Ravi Raj is asking, owners could be invested in multiple corporations, and that could lead to investors to desire high risk in particular venture. On the other hand, managers would require a long-term employment, and hence they could avoid high risk taking. Is this possible? Uh, this could be possible, as you say, Ravi Raj. Then how to prepare notes for the subject and able to revise at the exam time. Okay, Valika, how to prepare notes. I'll be uploading these handwritten notes of mine on the portal, guys. Once our today's session is over, I'll be putting this on the portal so you can download it. In fact, every lecture of mine is going to be followed by the same. Any other queries? What do you mean by outsourcing, Sushil? Any operation of the activity of a business can be outsourced, right? Maybe you may outsource your accounting activity. You may outsource some part of your production activity. You look at any big corporations, maybe for that case, Apple or Microsoft, they are not essentially manufacturing their products. They are getting outsourced from them. They are focusing on their core activity, and that is innovation and designing of the products. Making of the product is done by the outsourcing partners. Apple outsources it to Foxconn, Wistron, right? Okay, so I think all the queries are answered as of now. Okay, so yeah, so this is the first part which we are talking of scope and objectives of financial management. We are done with that. Now, I won't directly go to the next aspect, which is the sources of finance. Let me see if there are any queries. Otherwise, we'll just take a break and then come back and go with the sources of finance. What is the difference between current assets and working capital? Hardik, current assets is just your inventory, your debtors and cash. Working capital is a net of current asset and current liabilities. What is forecasting? Forecasting is estimating about the future. Is there a difference between joint venture, joint stock? Of course, joint venture is just a partnership between two companies. Joint stock is a listed company or a public company. Okay. Then meaning of substantial profit. Substantial profit means higher profits. Difference of budget and forecast. Forecast is basically your estimating. Budgeting is basically your budget will be based on a forecast. What you estimate will actually turn out to be your budgeted activity. Okay, any other? Oh, it doesn't seem to be as a query as such. No doubt. Okay. So let's do one thing. Let's take a break right now. A break of 10 minutes since it's a theory part. And post that, we will begin with a very comprehensive topic of sources of finance, which I've prepared it in a very nice way to look at it. I'll just show you a glimpse of this. This is what we are going to discuss after the break. We are going to discuss about the various sources of funds. So this book, or I mean, not the book, but this entire file, I'm going to upload it in the form of PDF for your reference. So this is going to be your entire chapter placed over here. All types of funds and everything are getting covered in this one single page. You can just take a printout of it and maybe look at it for a quick revision also. So let's take a break now, guys. Let's take a break of 10 minutes. Post that, we'll continue with this topic of sources of finance. Okay, enjoy your break. Be back after 10 minutes. Okay, welcome back, guys. After the break, let us continue with the next aspect of our today's session, which is talking about what are the various sources from where a company can raise funds. Now, one thing I can guarantee you in next 1 hour, there's going to be a lot of information flowing in because you will be amazed by the so much multiple sources of funds that the company can actually get from. So as of now, you know only equity shares and debentures and preference shares and bank loan. You'll observe that there are plethora of uh, sources from where the company can get the money because the capital markets have actually matured to a great extent, and essentially it's been a very run through thing as far as the capital market is concerned. Various sources, various other innovative ways of funding has come up. Okay, so without wasting much of our time, let's simply begin with the sources. So as we know, sources of funds can be categorized into two areas. Now, which are the two areas into which the sources of funds can be categorized? Either you can get your own money, get the money from the owners, or you can essentially get the money from someone else, that is, from a borrowed funds perspective. You can get owned funds to your business, or you can get borrowed funds. So that's how I have categorized into two parts. One is the owned funds category, and other is the borrowed funds category. Now, coming to the owned funds category, first of all, we'll take it one by one. Owned funds. Again, inside the owned funds, we are to bifurcate into two areas. One is we can get the owned funds from the domestic areas or from the international areas. Okay, so from the domestic areas or from the international areas we can get. So you can see you can get money from the domestic funds, own funds, or international funds. We'll talk of international later point of time. First of all, domestic funds. Domestic funds, you can also think it as internally you can raise own funds or you can raise money externally. So how do you get the own funds from in source? You get funds from internal sources or from your retained earnings. What are retained earnings? Whatever the company earns in the form of profits, in the form of cash flows, the company is not paying it out as dividend, but rather the company is flowing it back into the business. Instead of paying the full amount as dividend, whatever it has earned, a part of it is paid as dividend, and the major chunk is companies maybe retained by the company with itself. The major chunk is retained by the company with itself. That's your retained earnings. So these are basically whatever the retained earnings that belongs to the ordinary shareholders, and it increases the net worth of the business entity. As you keep the money with yourself and invest in other profitable opportunities, that increases the net worth of the business, right? Because when you say net worth, it's actually your equity share capital and the retained earnings. So more retained earnings the company has, the more is supposed to be its net worth. Okay. Then coming to the external sources, company can raise owned funds from external sources by way of equity share capital or preference share capital. By way of equity share capital or preference share capital. Equity share capital is basically a permanent capital, because have you ever heard that equity share capital is going to be redeemed? No, it's never supposed to be redeemed. It's a permanent capital unless and until company wants to buy back shares, but it's a source of permanent capital. Equity share capital actually represents the ownership. Equity share capital fund providers actually receive residual interest in income and assets. So they receive residual interest in income and the assets. Now, what do you mean by residual interest? Residual interest means whatever is left over by after paying to the shareholders, after paying all the other stakeholders of the company, like your debenture holders, preference shareholders, whatever is the final amount left, that is the residual interest that is received in the form of returns to the equity shareholders in income as well as the assets. So in both the cases, residual interest is going to be received by the equity shareholder. Next point is the equity share capital has got the highest cost of capital. Now, my question to you is why we say that equity share capital has the highest cost of capital. Now, when I say highest cost of capital, remember I'm talking of the shareholders expect the highest return as compared to a debenture holder, right? Because in the very first part of our session, we discussed that high risk, high return. So a debenture holder will require a lower return as compared to that of equity shareholder. And therefore, we say equity share capital is a high cost capital. Now, my question is, why would equity shareholder expect a higher rate of return? Obviously, because of the higher risk, and higher risk is actually perceived over here. See, it's a residual interest. Whatever is left over, that will be only received by the equity shareholder. That leftover may be very high, or that leftover may be zero also. So, taking that risk into account, it has got the highest cost of capital. Okay. Now, equity share capital actually provides security to other fund providers. Now, how is it happening, sir? How is it providing security to other fund providers? Let me just illustrate it before. Okay. Let's say you look at ABC company balance sheet. ABC company balance sheet. It has got equity share capital and debt. There's another PQR company. In its balance sheet also you have equity share capital and debt. So let's say ABC has got a equity share capital of 100, debt of 200. And PQR has got a equity share capital of 250 and 50. Now let's say both of them require additional debt of 50. Both of them require additional debt of 50. Banker would be comfortable in giving loan to which of these two companies? ABC has got equity share capital 100, debt of 200. So that totals up to 300 capital. PQR has got 250 and 50. That also totals up to 300 capital. Now tell me, banker will be more comfortable of giving loan of 50 to which one? ABC or PQR? ABC or PQR? Remember over here, ABC has already raised 200 in the form of debt. PQR has not raised much because it has only got 50, whereas equity component is high. Can I say for a banker, the second thought process would be ABC has already raised good amount of debt. There is not much equity as compared to debt because equity is basically half of that of debt. In case of ABC, equity is half of debt, whereas in PQR, your equity is 5 times of debt. Of course, PQR is more levered or more. We can have more confidence on PQR as compared to ABC. Because if anything goes wrong, the proportion which the banker is going to face risk is basically going to be lower as compared to that of ABC. And that's where we say this equity share capital, it gives confidence to the other fund providers. Okay. Clear? So if you are looking from funding point of view, PQR is a preferred choice because it has got more of owned funds rather than the borrowed funds. Clear? So that's where we say it provides a security to other fund providers. Okay. Now, what are the advantages? The best advantage is that it's a permanent and it's not, it's a irredeemable capital. So there is no obligation on the company to pay back the equity. Okay. Of course, it increases the finance base and help facilitate additional borrowing. That's what we have seen right now. So if you have a greater amount of debt, you will be, you will not be preferred for additional debt, right? Divya Kumari is asking, sir, PQR risk is so much. No, PQR risk is not so much. In PQR, equity shareholders have got greater stake. So owners are, owning a large portion of the assets. Whereas if you take debt, you are actually taking risk of it, right? Like if you buy a property worth, let's say, 1 crore by taking 90 lakh as loan, that is risky as compared to buying a property fully funded by your own. Right? So that's what we are talking about. The funding we were talking. Okay, so there's no obligation to pay dividend. Also, as a equity shareholder, you're likely to get rights issue. Now, disadvantage is that dividend income that you receive is taxable in hands of the shareholder. Similarly, it's a risky investment from the shareholder's point of view. If you issue more and more equity shares, that will lead to reduction in EPS and also dilution of ownership. So originally, whatever is the number of shares you have, or originally the amount of EPS that you had, that will get reduced if you're issuing more number of shares, right? So for example, let's say company had a equity share capital of, or maybe number of equity shares. Number of equity shares is 20,000, and profit after tax of the company is, let's say, 2 lakh. So earnings per share earnings is what? 2 lakh divided by 20,000, which is 10 rupees. And let's say out of this, there is Mr. A who holds 5,000 shares, and there are some others who are holding 15,000. Now, if the company goes for additional issue, so let's say the new number of equity shares, if it is, let's say, originally after 10,000 plus, then you had additional issue of 10,000 equity shares. That becomes 30,000. Now, out of this 30,000, you say that there is Mr. A who is having 5,000 shares, and there are others who are holding 25,000 shares. There's Mr. A who is having 5,000 shares, and there's another having 25,000 shares. So your PAT, let's say it remains same as 2 lakh. Now, what will be your EPS? EPS will be 2 lakh divided by 30,000. That will become 6.67. Can I say EPS has reduced from 10 to 6.67? Similarly, the ownership control. Here earlier, Mr. A had 25% control because out of 20,000, he was owning 5,000. Now his control is like out of 30,000, he's holding 5,000 only. So that translates to 16.67% stake. Correct? So that's where we say if you issue more and more equity shares, the EPS will get reduced, and even the ownership, dilution of ownership and control is also going to happen. Okay. So I hope equity share capital, some of the characteristics which you had known earlier and which we have discussed right now, something new also. Someone's asking that generally the debt equity ratio is 2:1. There's no such debt equity ratio. Arav, Priyanka, there's no such debt equity ratio, standard debt equity ratio of 2:1. It depends on industry to industry and the earning capability of the company. Are the interest earned from debentures taxable? Yes, debentures earned by interest are taxable, but they are deductible. I mean, they can be taken as a expense for the company. But in case of equity, the dividend that is paid by the company, that is not deductible for the company as a taxable expense, and also it is taxable in the hands of the shareholders. Okay. So now preference shares. Preference shares are again a type of owned funds, but these are hybrid form of funding. The rate of dividend over here is higher than the rate of interest, uh, because they obviously take a higher risk because they are second in line. So let's say if the company goes for dilution or company goes for dissolution or liquidation, whatever money is realized, that will be first paid to the secured debentures, then your unsecured debentures, then your preference shareholders, and finally your equity shareholders. Okay. Then you can have the types of preference shareholders as cumulative, non-cumulative, redeemable, participating, non-participating, convertible also. Now, what do you mean by cumulative preference shareholders? It means if in a typical year, if the company is not having profits, whatever dividend was not paid in that typical year, that will be carried forward to the next year, and next year the company will pay the dividend on the previous year's balance. Okay. Then uh, it can be non-cumulative also. Non-cumulative means if in a typical year company doesn't have sufficient profits, then company can simply not pay the full amount of dividend, and it's under no obligation to pay the same even in the next year. So that's a non-cumulative. Cumulative means your dividend keeps on accumulating. Non-cumulative means dividend doesn't get accumulated. Your redeemable, participating. Participating means the preference shareholders are entitled to get a share of profit, not at a fixed rate, but get a share of profit after a particular level of earnings have been reached. So let's say it can be a situation that the company has issued preference shares in such a way that uh, the company says if the company earns a profit of more than 20,000 crore, any excess of 20,000 crore, a part of it will be payable to the preference shareholders. Basically, preference shareholders are given an opportunity to participate in the profits, or they may be non-participating also, in which they are not allowed to participate in any excess profits of the company. They may be convertible also. By convertible, we mean that they can get converted to equity shares on expiry of certain time period. In terms of advantages, there's not going to be any dilution. Advantage of leverage is going to be there. Now, what is this advantage of leverage? We'll understand in the topic of leverage. There's no risk of takeover. Just by issuing preference shares, someone cannot become a full owner of the company. Dividends are fixed and pre-decided. They are obviously redeemed. Now, disadvantage is that preference dividend are not tax deductible. So whatever preference dividend is being paid, those are not tax deductible for the company. And in case of cumulative preference shares, there's always a risk on the company that there's always an obligation on the company that if there's any if there is any profits which are not yet paid, or the preference dividend has not been paid in a typical year, you need to pay it in the next year. So there's an obligation on the company in case of cumulative preferences. Yeah, so that's about domestic owned funds. So these things were, we were quite aware of earlier, just a bit of addition to it. Now I would like to take you to the next level of owned funds, which is your international level, which is global depository receipt. Now, what is this global depository receipt? We'll need to look at it in a bit different way. But before we go for GDR, or American Depository Receipt for that case, have you ever heard of this term, GDR and ADR? Have you heard of this term, guys? Global Depository Receipt and American Depository Receipt. Ever heard of it? No? Okay. So some of them have heard it. Okay. Uh, let's see what is this GDR all about. Let's say in India we have a company called as Infosys Limited. Okay. Um, it has issued its shares in India definitely, right? Uh, it has issued its share in India, but let's say it wants to capture the overseas market also in the form of getting funds, because generally you find that cost of funds in overseas market is lower. Now, Infosys Limited, if it simply takes its shares to the overseas market, and in the overseas market that share is just sold in the US market, is anyone going to buy the shares? No, because those are denominated in rupee terms. right? So those are denominated in rupee terms. So no one is definitely going to buy those shares. So there's a proper mechanism by which these shares will be offered to the overseas market. So how is that really going to happen? Uh, let's have a look at it. Before we go for this concept of GDR, we need to first understand what is a deposit. Are you aware about what is a depository? Can anyone tell me what's a depository? Is anyone aware of the term depository? Depository term, the term of depository, no? Well, let me tell you what is this depository. Depository is the entity that holds the shares of the investors in dematerialized form. Just like banks hold your money in the form of bank balances, same way these depositories hold the shares of the company, of hold the shares of the shareholders rather, in dematerialized form. So I can say depository is nothing but it's a bank of shares. So what's a depository? It is a bank of shares which keeps the records of shares held by all the investors. So various investors buy millions of shares, and all those records are maintained by depository. In India, we have two depositories. One is a CDSL, another is a NSDL. Okay. Same way, there would be a depository in US also. Now, in US, if you want to issue any dematerialized form security, you need to issue those securities through depository. You need to issue those securities through the deposit. Now, if you are really going to, uh, you know, put that money into the or put that security into the depository thing, I need to approach the depository. So let's say we have Infosys, and Infosys wants to issue shares. So Infosys takes its shares, let's say 10,000 shares, to USA deposit. Now, if these shares are directly listed in the US market, no one would be ready to buy because they don't know what is this rupee terms. So Infosys will definitely go to depository with its 10,000 shares, and the depository is going to issue receipt against the shares. Wherein it will be stated that one depository receipt equal to, let's say, 100 shares. So for 10,000 shares, 100 depository receipts will be issued in the market. Now, this depository receipt has got a legal backing of American entity. This depository receipt has got a legal backing of the American entity, and that will be recognized in the markets. Now, the investors in US market who would like to invest in Infosys Limited, they will buy the depository receipt by paying money in terms of dollars. Those dollars will be passed on by depository to RBI, and RBI in turn will get it converted to rupee for Infosys. Right? So the receipt that is issued in US market is called as American Depository Receipt. Okay, so receipts that are issued in the US market is called as the American Depository Receipt. Similarly, if any depository receipt is issued in India by a foreign entity, that will be called as Indian Depository Receipt. So any other form, if it is issued in Japan, that will be Japanese Depository. Issued in UK, that will be UK Depository Receipt. Okay, so these are basically the depository receipts which are issued by the depository of the other country against the shares of the home country. Okay, is the concept of GDR, or for that case ADR, clear to everyone? Is it clear to everyone? Is the concept of GDR clear to everyone? As the name says, depository receipts. So these are the receipts that are issued by the depository of the country from where you're going to raise the money. Yes, clear everyone? Perfect. So against the shares, so what happens is Infosys takes the shares to the depository. That's a US entity. The depository will accept those shares, and against those shares, it is going to issue one depository receipt signifying 100 shares. So there will be total 100 depository receipts for 10,000 shares that will be issued in the market. US market will pay dollars to the depository. Depository will remit these dollars to Infosys. Okay. Okay, fine. So we are clear. That's your global depository receipt. And if you issue it in US, that's your American depository receipt. If some foreign investor is coming to India or investing in, that's your Indian depository receipt. Okay. Now, that's your first part. There is your own funds that we are talking of. Okay. Next is coming to the borrowed funds. Now, again, in the borrowed category, we have the international funds and we have the domestic sources of borrowed funds. So let us come to domestic sources first. So in domestic sources of funds, first up we have the seed capital. One second, Lenshi is asking is depository of USA of India. The depository will be of USA. NC Saxena depository will be of USA because we are in USA. Obviously, if you want to issue receipt in USA, the depository has to be of USA because that has got a legal backing, right? Okay. Seed capital is basically this is designed by IDBI for startups. Remember, it's a domestic source of debt fund. Domestic source of debt fund. So we are talking of seed capital. This is basically designed by IDBI, Industrial Development Bank of India, for startups. Now, what is this seed capital? IDBI gives interest-free loans to the startups. They don't charge interest, but they name it as service charge of just 1% for first 5 years. So for the first 5 years, IDBI is going to charge you just 1% of the money. And once the company reaches, a bit of, earning capability, then the rate of interest starts increasing. Okay. So repayment and rate of interest charge depends on the repaying capacity with the moratorium of up to 5 years. So repayment and rate of interest charged. What is the rate of interest that will be charged depending on how good the startup has really performed. If the startup has really performed good, then obviously the higher rate of interest will be charged. Okay. Then domestic sources, you may also issue something called as zero coupon bonds. Okay, instead of zero coupon bonds. Now, what is this zero coupon bond? Uh, Zero coupon bonds are basically such a debenture which are issued on which no interest is payable, but they are issued at a discount and redeemed at par. So basically, company issues a debentures maybe at a price of first of all we need to understand what is this coupon, by the way. Coupon is basically the amount of interest which the company is going to pay. So let's say, as I said, zero coupon bonds are issued at discount. So let's say issue price is 80 and redemption value is 100. So company will actually receive this 80 from the investor in 0th year and maybe pay this in second year. So what is the interest what's the interest that is basically getting earned? Can I say 20? 20 is the interest cost that the company is bearing over a period of 2 years without payment of any intermediate interest amount. Okay. Issue price and redemption value, the difference between them is going to be the interest earned. These are basically zero coupon bonds. So zero coupon bonds means no coupon is being paid during the life of the bond. Rather, the difference between both is just the earnings, or that's just the income for the investor, and that's the expense for the company. Similarly, we have secured premium notes. Secured premium notes are basically redeemable notes issued along with detachable warrants. Warrants need to be converted within time period notified by the company. So these are secured premium notes, redeemable notes issued along with detachable warrants. Now, what are these detachable warrants? See, so you have a debenture. You have a debenture in which the face value of debenture is specified, the rate of interest is specified, but along with that, there is a detachable attachment to it, which is a warrant. Now, what is a warrant? Warrant means it gives a right to the holder of this warrant. It gives a right to the holder of this warrant to buy the shares of a company at a fixed price. Whatever be the price of the share, if anyone has got this warrant, he can buy the shares at rupees 10. That is the additional thing that you get along with the debenture. So this debenture remains on which you are getting the fixed rate of interest. But on expiry of certain time, a warrant that is attached to it, you can remove it and go to the company and ask for the shares of the company. Okay, that's your detachable warrant or secured premium notes. Secured premium note means it's a debenture with an attached warrant. Warrant gives you a right to buy the share at a fixed price, not on the immediate basis, but after expiry of certain time. Let me see if there is any queries. What is the basis? They give loan to startups. Basis means a business idea, basically. So for 5 years, only 1% rate of return, even if the startup earns more income. Yes, Lokesh. Till the tenure of 5 years is expired, the rate of interest will be 1%. Post that, the rate of interest will be higher depending on what the company has earned. Are the zero coupon bond listed on stock exchange? Yes, they are. What is moratorium? Moratorium is basically if you take a loan for a certain time period, you need not pay the interest. Interest will accrue. Remember, interest will accrue, but you need not pay it. Interest will keep on accumulating over the debenture or over the security. Okay, so you take a bank loan and you did not pay the EMI for certain time period. That is what you mean by moratorium. EMI will commence later, but definitely interest will keep on accumulating. Interest will be added to the principal. Harshvardhan is asking, sir, what if in this warrant case, if the price of the shares fall? No, you're not required because it gives you a right. Remember, Harsh, this is going to give you a right. It's not putting an obligation on you. There's no obligation on you to buy it. You have a right. If you like the price of 10 rupees, you buy it. If you don't like it, you don't buy it. There's no obligation. Okay, guys? Fine. So that's your secured premium notes. Then also sometimes the promoters or the owners of the company are required to provide unsecured loans to meet the promoter's contribution now. Sometimes the promoters are required to give loan to the company also as a security or as an additional capital infusion. Okay. Then coming to the other aspect, these are basically the long-term sources of funds, domestic long-term debt funds. Then you may have short-term, long-term, or medium-term loans from commercial bank. Now, loans from commercial bank is what you say as a bank loan. You can get a medium term loan, a long term loan, or a short term loan also from the bank, right? Then you have a floating rate bond. So floating rate bonds are basically the bonds on which the rate of coupon is fluctuating depending on market conditions. So floating rate bonds are on which the rate of interest is not fixed, but that is dependent on some other parameter, right? So as the rate of interest changes in the market, the amount of interest that you get is also going to change. For example, if it's a normal point of view, if it's a normal bond, let's say as an investor, from the investor's point of view, you acquired the bond by paying 1,000. The company has promised you 9% coupon. The company has promised you 9% coupon. So for year 1, 2, 3, 4, 5, for all these 5 years, you are getting paid 90 as the interest every year. And then at the end of fifth year, the principal is redeemed. At the end of fifth year, the principal is redeemed. So 1090 is what you receive. This is a fixed rate bond. We may also have floating rate bond. And floating rate bond, let's say the rate of interest is stated as whatever is the RBI repo rate plus 3% on them. So rate of interest is basically RBI repo plus 3%. So here 1, 2, 3, 4, you can see cash flows will differ according to the repo rate. Let's say in first year repo was 5%, you will receive 5% plus 3%. It means 8% interest. So 80 rupees will be cash flow. Second year, if the repo turns out to be, let's say 6%, so you will get 6 plus 3, which is 9%, 90 rupees. Third year, it is 5.5, let's say repo, so you will receive 8.5. And finally, last year, if you have 7%, it is 7% plus 3%, which is 10%. So you'll receive 100 as the coupon. So your rate of interest, your amount of interest that you receive, it keeps on changing according to RBI repo. Is this clear? So that's the floating rate. There's a floating rate bond. I hope floating rate bond is clear. Let me just answer the query. If market price is less than fixed warrant price, then at what price holder can buy? Holder will not be able to buy at a fixed price. If market price is lower, rather the investor will go to the market and buy it. Can we sell such right? You can. That depends on, again, terms of warrant, whether it is negotiable or not. Then Harmisha is it possible RBI repo will fall? It's possible. If interest rates are lower, if the inflation is lower, RBI will definitely reduce the repo rate. And Tanishka is asking, is the 3% always fixed or only for example? It's just for example. 3% is just for example. That depends on type of bond. Somewhere you get 3% additional, somewhere you get 2%, 5%. That depends from company to company. Okay, so these are your floating rate bonds. Now, coming to the other long-term and medium-term sources. We already know what are debentures. Debentures are basically the loan instruments issued by companies to the public at large. It may be denominated from 100 to 1,000. Debenture trust deed, will list down the terms and conditions. Maturity may be from 3 to 10 years. Obviously, this has got a low cost of capital. They may be convertible, non-convertible, or partly convertible also, and can be bearer, registered, or mortgage, or naked. The duration of floating rate bonds may vary, of course, yes. Depending on what is the time period for which the company needs funds, the duration may vary. Okay. Then we have something called as what do you mean by zero coupon bond? Sushil Kumar Barik. I have explained that, Sushil, earlier. Zero coupon bond is the bond where no coupon is being paid, no interest is paid during the life of the bond. Entire payment happens at the maturity. Zero interest, fully convertible debentures. These are compulsorily and automatically, since they're saying fully convertible, Fully convertible debentures. It means they are debentures, but on maturity, they are going to be compulsorily converted to, they're going to be compulsorily converted to equity. So compulsory and automatically converted after a specified period of time, and holders thereof are entitled to new equity shares of a company at a predetermined price. So these are zero interest, no interest payable. On maturity, the investor has an opportunity to get the cash against the maturity value or to receive the shares, but here it is compulsorily convertible. So it means they are definitely going to get converted to equity shares. Okay. Now, difference between bonds, debentures are basically from the corporate point of view, and bonds are generally, we say, these are government securities. Okay. Inflation bonds are the bonds in which you are getting interest rate adjusted with the inflation. These are the bonds in which interest rate is adjusted for inflation. For example, if interest rate is 11% and inflation is 5%, investor is actually going to receive 11 plus 5, that is 16% in total. Okay. Now, there are types of debentures that we see: bearer, registered mortgage, or naked. So, bearer means just like a normal bearer check. Anyone can buy the debenture, anyone can sell the debenture, and you need not tell the company that you are going to, you're going to sell this to someone, or someone need not tell that I have purchased it. So there is no registration required of those bonds if there are bearer bonds. If they are to be registered, every time the company buys, every time anyone buys the company debentures or sells the debentures, that need to be registered with the company. That's your registered bond. Mortgage debentures, it means they are secure. You have a charge created on them, a fixed charge or a floating charge created on them. Unsecured debentures are also called as naked debentures. I hope all these four are clear. Ninad, bearer, registered, mortgage, and naked. Bearer means you can deal it as if it's a bearer instrument. You can transfer it just by exchanging the hands. You give it to someone, that bond becomes his. Registered is you need to register it with the company every time. And mortgage means you are getting it secured. And if it is naked, it means unsecured. I hope that makes sense to you guys. Okay. Now let's go for some short-term sources of borrowed money. Short-term sources of funds. So short-term sources of funds, you can have it in the form of advance from the customers. Advance from the customers, any money that you receive in advance from the customer, that acts as a immediate source of fund for you. Similarly, if you're going to make late payment to your creditor, you are actually utilizing that money into your business. Any accrued expense and deferred or unearned income. Yeah. What is coupon? Mr. Devraj, coupon is nothing but the interest that you receive, the fixed amount of interest that you receive from the bond or the debenture. Okay, so short-term sources, any advance that you receive from the customers, any trade credit, accrued expenses, and any deferred or unearned income. These are basically your short-term sources, right? Now, commercial papers. These are an important source of short-term funding called as a commercial paper. What's the commercial paper? It's an unsecured money market instrument. Now, when you say money market and capital market, can you tell me what's the difference between them, guys? Money market and capital market. What's the difference between them? What's the difference between money market and capital market? Waiting for your answer, guys. Yeah. So in capital markets, guys, the funds are raised for a tenure more than a year. In money market, the funds are having a maturity, or the instruments are having a maturity less than a year. So when I say money market instrument, this is going to be essentially like a debenture, a short-term debenture basically. So a short-term debenture which is having a life of less than a year. So this is issued and in the form of a promissory note, issued obviously by a high-rated corporates. High-rated corporates. It means some of the well-established companies are only permitted to issue this commercial paper, uh, and primary dealers and all India financial institution. Right? Each commercial paper is going to be having a value of minimum 5 lakhs or any multiples thereof, and rate of interest is going to be linked to 1 year government. Linked to 1 year government bond means, of course, the company is not going to offer 1 year government bond credit. The company is definitely going to offer something higher than that. So the rate is actually based on government bond. So if the government bond is 7%, I may be offering maybe 9 or 10%. If the government bond is, let's say, 10%, then I will be required to offer a rate of even higher than that. Okay. Now, of course, these commercial papers are mandatory to obtain credit rating. Commercial papers are, it's mandatory for the commercial paper. Now, similar to commercial papers are treasury bills. So, treasury bills are short-term government securities with a maturity ranging from 14 to 364 days. Okay. So, treasury bills are basically government securities which are issued by the government of India through Reserve Bank of India and having a tenure from 14 to 364 days. Similarly, certificate of deposit, it is similar to time deposit receipt issued by a bank. So it's the bank which issues that certificate of deposit. For a corporate, it is commercial paper. For a bank, it is called as a certificate of deposit. There's no prescribed interest rate on such funds. It is traded in the secondary market. Even the commercial papers are traded on the secondary market. Okay. Then company may simply accept public deposits subject to a maximum of 35% of its paid-up capital. This is what you might have learned in your law also, in the subject of law. Then you have intercorporate deposits. Intercorporate deposits are basically short-term borrowings from other corporates who have surplus liquidity. So one company may invest in some other company debentures. That's what intercorporate deposits. Other source of short-term funds are taking overdraft from bank, or making maybe arranging for a cash credit facility. Now, overdraft is basically you are given a loan in the same bank, or you're in the same bank account. You're allowed to take a negative balance. Cash credit is an arrangement where under which a customer is allowed an advance up to a certain limit. So you can borrow up to a certain limit, but that is actually pledged or hypothesized by tradable goods. So you're actually keeping your goods in hypothecation. You're creating a security on the goods. And just like, overdraft, cash credits are also going to be renewed annually. Getting the bills and, getting it discounted from the bank is again a source of your short-term borrowings. Okay. Then we have the concept of securitization. But before that, let me see if there are any specific queries. Money market. And please, commercial papers are mandatory for credit rating. That's a requirement by RBI Bhumika. RBI asks for credit rating of the commercial papers because the public is going to get involved. Okay. Fine. So let's go ahead with this securitization concept, guys, with the help of an example. Let us say we have SBI over here. Okay. Before I answer this, before I go ahead, let me answer a query. So if a person have ownership by having more than 50% shareholding, then it means that he can take decision of the company also. Yes, Nancy, you can write. You're right. You can take the decisions of the company. Harshvardhan is asking what's the difference between the overdraft and cash credit. Overdraft can be unsecured, Harshvardhan, but cash credit can never be secured. Sorry, cash credit can never be unsecured because cash credit is going to be secured by the amount of the inventory that you have. These all are borrowed funds. Yes, Tanishka, these all are borrowed funds we're talking of. There's a new concept of securitization that we are talking of right now. Pay attention, guys. So let's say State Bank of India has got a set of assets in the form of loans and advances. Because as you know, in bank, the asset is basically the loans that they have granted to the outsiders. So let's say in the loans and advances, SBI has got a home loan total portfolio of 1,000 crores carrying a rate of interest of 9%. So basically, SBI has granted a total loan of 1,000 crores on which it is earning 9% interest. But the problem is this entire 1,000 crores is tied up with this loan. Now the company is basically having some sort of liquidity issue, right? How do we resolve this? The company wants to maybe, liquidate this home loan. So it approaches a special purpose vehicle, or maybe it creates a special purpose vehicle uh, to which we will be transferring this home loan. This entire amount of home loan will be transferred to the special purpose vehicle. Okay, so this home loan will be transferred to the special purpose vehicle. It means the EMIs, the right to recover the money. If some debtor goes bankrupt, to collect the money or to take the possession of the property, all those rights we are going to give it to SPV. And SPV has agreed us to give 990 crores against 1,000 crores. Now, of course, SPV, as we transfer these home loans, the SPV also presumes the risk of non-payment by the borrowers also. So SPV, special purpose vehicle, the idea is to get an upfront payment, from the SPV, special purpose vehicle, and we are trying to liquidate our home. Now the question arises from where the money will flow to SPV. SPV will approach the public at large and it will tell them that we are going to raise, we need money for buying the SBI home loan portfolio. So for that, they need 990 crores. They approach the banker, they approach the public at large with their bonds. And these bonds are called as mortgage-backed securities. So these bonds are going to be called as mortgage-backed securities. Okay? Because these bonds are secured by the mortgages. Rather, whoever buys these bonds in the public from SBI, from this SPV, is going to receive interest, let's say, at 8%. Is going to receive interest at 8%. And how is this 8% going to flow to the public? Because these home loan borrowers are going to give 9% to SPV, and SPV in turn is going to retain 1% margin for its own operating activities and pass on the money to the bondholders. Okay. So the thing is, if there's a default, anything that happens with the home loan, SPV is going to bear it, and ultimately the risk is going to be on the public. So these bonds are called as mortgage-backed securities, because these securities are backed by the mortgages which are obtained by SPV. Okay. Now, if the quality of this home loan portfolio is not so good, it means there are no bad debts happening in this home loan portfolio, then the public at large is going to get affected, because the money will stop flowing to SPV, and ultimately the public shareholders, the security buyers in the public, may have to settle for lower rate of interest. And that's where we had the subprime crisis in 2008. I would request every one of you to, uh, look at this subprime crisis. You can just watch out or some videos on YouTube for subprime cases to know more about what these mortgage-backed securities are. Okay, so let me see. There are any queries. What's the difference between overdraft and cash credit? As that I have answered already. Cash credit is equal to short-term borrowings like bank overdraft. Yes, but it is a secured borrowing because you are getting your loan against the security of your stock. Why is this name cash credit? Because it's just like a cash thing wherein you can get the money withdrawn from the bank anytime and you can credit the money into the bank anytime. So withdrawal and deposit is just like any having a cash account with the bank. So what if SPV received only 600 crores? Does SBI repay the unpaid amount? No, no, Shriram. SPV, if it is able to recover only 600 crores, that amount will be only paid to the public. The SBI is dissolved. SBI is absolved of all the liabilities. That's the benefit of this. What about the remaining 10 crores? 1,000 crores was the amount of loan outstanding. SPV will undertake its own analysis in which it will say that out of this 1,000 crore, 10 crores is not recoverable, so they're not ready to pay for it. Okay. So securitization is basically transfer of loan by a bank to another entity, and that another entity gives money to the bank by raising that money from the public at large by issuing securities. By issuing securities, the public can get these things. Public can, SPV can raise money from the public and buy the securities accordingly. Okay. SPV is special purpose vehicle, a special entity created for the purpose of securitization. Raju is asking, cash credit will issue on the basis of working capital. Yes, it will on the basis of working capital. That is on the basis of the net working capital or net current assets of the company. Correct. Now, let's look at this bonds. Name of the bonds, you can say there are a few fancy names. If it's a Yankee bond, it means these are basically the bonds which are issued in USA by non-US banks and corporations. So let's say if Indian entity wants to issue bonds in USA. Obviously, the currency is going to be in dollars. Then those bonds that you're going to issue in US are going to be called as Yankee bonds. Similarly, if you are issuing some bonds in Japan, then it's samurai bond. If you're issuing some bonds in London, then that's the bulldog. Okay, so these are some of the fancy name of the bonds that a foreign entity will issue in the respective countries. Okay. Then we have export finance. Export finance. So export finance is you can receive the finance before the shipment or after the shipment. Okay. Before shipment means you are an exporter who is going to export certain goods to a country outside India, and you're in the process of making that product, or you're in the process of making that manufacturing of that product. And if you receive any such finance before the shipment is made, before the product is made and shipped or exported, that's called as packing credit. So packing credit is basically an advance extended by banks to the exporter for purpose of buying, manufacturing, processing, packing, shipping goods to the overseas buyer. So an exporter having at hand a firm export order placed with him by his foreign buyer or irrevocable letter of credit open to his trader can approach a bank for availing packing credit. So when an exporter receives a firm order, a confirmed order that the goods are going to be exported, he can approach a bank and then he can get a packing credit. Okay, so if it's a clean packing credit, then it is available to an exporter only on production of a firm export order. So in case of if you're going to produce a firm export order, a confirm order, then we are going to get this clean packing credit. ECGC cover should be obtained by the bank. Export Credit Guarantee Corporation cover. That is, you should take a guarantee from ECGC. It's an entity which provides guarantee that your exports proceeds will be realized. Similarly, packing credit against hypothecation of the goods you can arrange. Packing credit against the pledge of goods, or maybe against the ECGC guarantee or forward exchange contracts. These are the various forms of pre-shipment product or pre-shipment exports. Similarly, post-shipment, you can simply get a bill discounted. You can get a ECGC on the basis of ECGC guarantee. You can get a loan from bank, or you can also get advance against export bills which are sent for collection. You can also get advance against duty drawbacks or any subsidy that you're going to receive from the government. Okay, Shriram is asking what's the difference between Yankee bond and ADR? Yankee bond, remember, Shriram, it is bond. It's a debenture that you're going to issue. In case of ADR, you're issuing securities. You're issuing shares of the company. Okay. Now, some other forms of financing is foreign currency convertible bonds, which are bonds which are issued at a very low rate of interest. Similarly, convertible FRN, an option to convert it into long-term debt with a specified coupon. Protection against falling interest rate is given. Similarly, you have drop block bonds. So drop block bonds are a typical bond in which floating rate bond will get converted to a fixed rate bond if the interest rate falls below a predetermined. So bond may say that if the interest rates, let's say if RBI repo rate falls below, 3%, then the bond will become a fixed rate bond with 4% rate of interest. Same way, variable rate demand obligation, the holder of the floating rate note can sell the obligation back to the trustee at par plus accrued interest, thus making it more liquid. So variable rate demand obligation is basically where the holder of the bond has the option to give the bond back to the trustee or back to the company. So these are inverse floater yield curve note in which the yield increases when the prevailing interest rate declines. So these are inverse bonds or inverted bonds in which the rate of interest will, if the market rate of interest increases, the yield on the bond will decrease. Similarly, we have masala bonds, which are the bonds issued outside India but denominated in Indian rupee. Municipal bonds are bonds issued by the municipal authorities for financing of urban infrastructure. Like you have many bonds issued by Lucknow Municipal Corporation. You have bonds issued by Delhi Municipal Corporation. You have bonds which are issued by even the uh, Mumbai Municipal Corporation. So these are corporations which issue bonds for development of infrastructure in the municipal areas. Government or treasury bonds, as we are aware of, one of the type is treasury bills, right? So this is the entire set of sources of funds that we have been discussing about. Some of them I might have not covered for the simplicity thing. I'll just try to cover the queries if we have any. SPV is taking huge risk. Yes, Shiram, you're right. SPV is taking risk. What is a SPV? What do you mean by duty drawback? Sushil, duty drawback means for production of any export item, if you have paid excess like GA or duty, you get a refund of the same. And that's what we call it as a duty drawback. Okay. Are there any set of queries? I'll just wait for a couple of minutes. If there aren't any queries, then we'll call it a day. Okay. Are the rate of returns on bonds issued to public in case of securitization fluctuating? No, Sahitya, those are not fluctuating. Those are fixed. Okay, I think I've answered all of them. Masala bonds also you have studied. Divya, okay. That is done. Maybe I'll just wait for 1 minute. Any queries, or else we can call it a day. Don't we have any reference from study material for what? You can look at the study material. In the study material, find all these things in paragraph form. I've just put it in the form of a proper chart. What is venture capital funding? Which is basically investing into startups. Can debentures be converted to preference shares? Yes, they can be. Chapter 1 and 2. Yes, chapter 1 and 2 we are done. Okay, so done. I think we are done for the day. There are no queries other. I'll be uploading this chart. Definitely, I'll be uploading this file on the portal, guys. You need not worry about that. Okay, so let's stop here for the day, guys. See you in the next exciting lecture again, or probably on Thursday. We'll meet up again and we'll take up with another interesting topic for that day. So, till that time, be happy, enjoy, take care, bye bye.